Hi, and welcome to our class on financial risk management. Last week, we discussed axiomatic risk measure theory, more precisely the theory laid out by Arzner, Dilbin, Eber, and Heath, which I mentioned is based on a joint paper of those colleagues from, I think, 1999 in Mathematical Finance, which was called Coherent Measures of Risk. Quite important paper, still is, because it introduced the notion of a coherent risk measure to the not only mathematical finance but also to the finance literature. And coherent measure of risk or coherent risk measure means that you have a risk measure which is formally defined as a function on the set of possible risks, possible loss distributions, and a risk measure is coherent if it is translational invariant, positive homogeneous, and subadditive. Have I missed out one? Translational invariance, positive homogeneity, subadditivity. Actually, I can just go back a couple of slides, and here you can see we have monotonicity, positive homogeneity, subadditivity, yes, and translational invariance. So if you have a risk measure that fulfills all these four properties, you get what we call a coherent measure of risk. And the question now is, what are more practical examples of risk measures, and how do these risk measures fare when looked at from the perspective of coherent risk measures? So we'll start with some basic risk measures you probably already know. The mean loss, the expected value of the loss distribution. We could also think about the variance or volatility of the losses. So this would give us the variance or the standard deviation of the losses. Or we could also use the maximum loss, which is just the infimum of the loss distribution. Now, all mentioned characteristics of a distribution, all these mentioned, actually they should be moments, and Kennzahl, good translation here. All these moments of a distribution, they all share different disadvantages when it comes to risk measurement. For example, let's start with the variance or volatility. The variance and volatility is non-negative. It's zero or positive. So even if you have a loss distribution that only gives you profits, which we wouldn't consider economically, which we wouldn't consider to be a risk, then still variance and standard deviation would be non-negative. So this is the problem with the variance and standard deviation. It gives the same weight to positive and negative deviations. That's probably not what we are looking for in risk management. Next, the maximum loss is quite extreme. The maximum loss is quite extreme in the sense that, well, in the long run, we are all dead. We can lose everything, but this is something we can work with on a daily basis. That is, assuming that every day we can go bankrupt. We don't need risk management for that. The same actually with the expected loss. In some cases, especially in market risk, expected loss doesn't really help you, because then it depends on the purpose of risk measurement. If, for example, you want to have a safety buffer of capital, then probably the expected loss is not the right way to go. In credit risk, actually, this is quite different. In credit risk, you do work with the expected loss, but what you do is, and we'll come back later to this, in credit risk management, you often do the following. You have a loan, you have a claim against someone, and you say, well, okay, I have to ask for a certain interest rate, let's say 5%. And how do you calculate the interest rate? Well, what you usually do is, let me just see, you would start with the cost of capital, which in this case is simply the risk-free rate R. And then, on top of that, you need something that accounts for risk. So you need a risk premium, and the risk premium is how do you calculate the risk premium? Well, usually you would say, okay, I have an expected risk that I can already expect right now, and the expected loss is actually used. I write it in here. It's not that I would insert this here, but the expected loss is used to calculate the expected part of your risk premium. So if you're already expecting this amount of loss for this loan or in this portfolio, you can price it in. And then the remainder is what you would call the unexpected loss, and this would actually be probably not included in the interest rate, but you would say, okay, well, this can happen, it cannot happen, and you would account for this by keeping a capital buffer. And this is what is done, for example, in Basel II and later on Basel III. So expected loss, yes, in credit risk, but not always, not for all types of risk. Then the maximum loss and the expected value, they are also not robust against extreme values. For example, if you only have one extreme observation, if you have one outlier, both the expected value and the maximum value, they will suffer to a great extent from this outlier. So they are not robust against extreme values. Again, not so much and not so well suited for risk measurement. So what should we do instead? What has become industry practice and industry standard basically is the so-called value at risk, or VaR. Now it started with the amendments to the German supervisory law, which we call Grundsatz 1, back in the, I think, early 90s, when credit institutions were permitted to use value at risk models used for internal bank management purposes to calculate, or not only internally, for example, the expected loss in credit risk management, but they were also allowed to calculate regulatory capital requirements for market price risk of the trading book. This doesn't seem to be such a big deal, but it actually was, because internally, in your internal processes, in internal accounting and internal bank management, you can do whatever you want. The regulator doesn't really care. But when it comes to regulatory capital requirements, the regulator and the supervisor, they set the rules. And what was now allowed was that banks could use the value at risk models they were using anyway in their internal bank management. These models could also be used to calculate the regulatory capital requirements. And these regulations were then incorporated also in the Solvabilitätsverordnung, the solvency regulation. And with the regulatory recognition of VaR as a risk measure for determining regulatory capital, all banks started to use value at risk internally and for external purposes. So it basically became an industry standard for market price and credit risk. However, and this is now interesting, after 1999, so basically 10 years after banks started to use value at risk, people and mathematicians looked at value at risk and they saw, well, it can be problematic because it is not always coherent. It's not a coherent risk measure. So let's define value at risk. We look at a portfolio of risky assets with a loss distribution L and a fixed time horizon. FL is the distribution function of the corresponding loss function, the loss distribution. We neglect at this point whether we are given L, whether we need to linearize L. We don't care if it's conditional or unconditional. We are only given a loss distribution, capital L, and we need to calculate the value at risk. And the value at risk can now be interpreted as the loss that is exceeded with a certain fixed probability. So this is the precise and mathematical definition. We are given a confidence level of alpha, and the value at risk of a portfolio or a single investment at confidence level alpha is given by the smallest number, small l, for which the probability that the loss exceeds capital L is not greater than 1 minus alpha. So it's the infimum of all those losses, such that the probability that the actual loss is larger than small l, that this probability is smaller than 1 minus alpha. So for example, you would choose alpha being 5%, 1%, 0.5%, and this is the valued risk. So in practice, you would have confidence level of 99. You always have to be careful whether you define it 1 minus alpha or smaller or equal than alpha or beta. So usually you will choose very, very high confidence levels, 99, 99.9%, used to be 95%, 97.5%, but regulators have moved on to higher confidence levels now. The time horizon in market risk management is usually 1 week, 10 days. In credit risk management, it's usually a year. And by definition, the valued risk does not allow to draw any conclusions on the amount, on the probability, actually on the probability, but only in some, but on the amount of losses incurred with probability 1 minus alpha. So what is the valued risk? If you haven't understood the definition already, let's look at a profit and loss distribution that might look like this. Then the valued risk is a quantile. It's nothing but a quantile. And you would argue that you have alpha percent here in this area where you are suffering extreme losses. Okay. And yet you have 1 minus alpha probability in this area. That's the remainder. And you know that this is the valued risk. In this case, it's the alpha quantile. So it's actually a fancy name for a standard statistical moment. It's just a quantile. The 50% valued risk would simply be the median. And now you can understand why you usually choose 1%, 0.5%, because if you have a loss distribution that looks like this, you're interested in those extreme losses where maybe you have 0.5% probability. As you can see from these two plots, you don't have any information about how the distribution goes on here. It could be that it looks like this, and this is the maximal loss. You only know that the whole probability mass left of the valued risk is alpha. So this is what I mean with that you cannot draw any conclusions on the amount of losses incurred with probability 1 minus alpha or beyond this point. So as you can see, it depends on how you define alpha. If you define alpha with 99%, obviously this wouldn't make too much sense. So in this case, alpha would be 1%. Okay. You can also use a variation, which is the so-called mean valued risk, which is simply defined as the VaR minus the expected loss. You can do this. It's economically a little bit more interesting, I guess, but it's still a quantile. Now, on this page, I wanted to show you how to define the valued risk in the terms of a quantile. This is, I guess, a little bit too much for those who are studying non-mathematics or economathematics, so you can leave this out. I only wanted to point out to you that you cannot just say, well, we're using a quantile, full stop. In some cases, for example, for discrete random variables, it's not so easy to define a quantile or the quantile function and to make sure that the quantile is unique. So for this case, for some cases, you need the so-called generalized inverse. The inverted function, the inverted distribution function is the quantile function. You need a function, a distribution function f, and the generalized inverse is then called the quantile function. In case you have a continuous and strictly monotonous generalized inverse, then it's the inverted distribution function. That's usually the case with continuous random variables, but because you cannot be sure that you always have a continuous random variable, one can define the so-called generalized inverse. So what we can see is the valued risk is a quantile. Okay. Now for normally and t-distributed loss distributions, the valued risk is given by an analytical formula. As you can see here, we have the expected value mu, the variance sigma squared, and then the valued risk for the normal distribution is simply given by mu plus sigma times the quantile of the standard normal distribution. The same actually with the t-distribution. You see you have mu plus sigma times the quantile, the alpha quantile of the standard t-distribution. And you're done. Now a practical example from the risk report of Deutsche Bank. You can see here this is right before the financial crisis in 2006. You can see that they have to report the valued risk model and some details on their valued risk model in their risk report. What Deutsche Bank actually also does is, I don't think they are required to do this to show this plot. They show this plot from their trading activities, and they show that, well, actually the valued risk is usually it's always below the daily losses from their trading activities. This is in 2006, right before the financial crisis. Now, if you want to see a completely different picture, you would have to pull up the risk report for 2007 and 2008. You would see extreme losses in their trading business, and you would see a plot that would look like this, with some extreme losses that were not captured by the valued risk. The question now is, if you see this, and let's delete those losses for a minute, would you say that the valued risk model is adequate in this case? Well, this is a tricky question. During the great financial crisis, one would hear statements like this from bankers, especially from small banks. Why did we incur such high losses? We had a value risk model in place. But how could this have happened? Regulators and financial mathematicians and researchers told us that the valued risk can never be violated. The valued risk is defined to be the loss that is never exceeded in 100 days. And immediately you would see, well, people didn't understand the concept of valued risk. If you go back to this definition, you would see that, actually, let's go to the plot. If these are 100 days, this would mean that on 99 days, if you have the alpha, if you set alpha equal to 1%, this would mean that on 99 of those days, you are here. But on one day, you can be here, but you can also be here. And obviously, if you set alpha to be 95%, 99%, or 1 or 5% equally, and you have your risk model in place and it is estimated in the right way, it doesn't mean that you will never incur loss. It only means that there are 5% or 1% days on which you will suffer a loss that will exceed valued risk. And if we now take to the example of Deutsche Bank, could be that the loss looks like this, but it can also be like this. Well, the valued risk model isn't wrong, it's right. It's not that the valued risk and valued risk model can forecast all losses. This is like forecasting lottery numbers. It only tells you with a certain probability that the losses you will incur will stay above the valued risk for 95% of the days with a 95% confidence level. And if you take the great financial crisis and you have a daily, or let's say a yearly risk model in credit risk, well, if it's set to 99%, this might just be the black swan. 2007, 2008 might have just been the 1 year in 100 years, in which you would incur such a loss. And this is what bankers didn't realize before the financial crisis. Everyone complained about risk models, and no one was aware of the risk, the model risk of these models, and the fact that people misused these models. The question next question is, what is an optimal valued risk model? If this is, for example, the 99%, well, I would say if this is a 99% confidence level model, this isn't really perfect because, and this isn't right, because ideally it would probably look like this. It is able to forecast losses more accurately, and the confidence level in this model is probably not 100%. So there should be at least one exceedance. We call these points VAR exceedances or VAR violations. There should be at least one violation. And next, the easiest way to come up with a model in which we are able to have no exceedances, well, the easiest way is to do this. To be extremely conservative. However, the valued risk is used in banks to set regulatory capital. So the blue line is very conservative. Yes, we are safe from any financial losses from trading activities, but this will be, you can imagine, this alternative, this blue line, this will be very expensive. Because in this case, the bank would keep too much regulatory capital on its balance sheet, which is needed as a risk buffer. And this would also be a problem. Of course, if you have a risk model that looks like this, give me my red line. If you have a risk model that looks like this, this is too optimistic. You're incurring too high losses and too many losses. So this would be a risk model that is also inadequate. And now you can already see how to backtest these models. You have to check for the VAR exceedances, and you have to check for two things. First of all, you have to check for the correct number of VAR exceedances. If you have 100 days, let's say if you have 100 days and you're looking at the 5% VAR, then obviously you would expect around 5 exceedances in a year or in this period. And the second property would be that you would probably like those exceedances to be independent over time. It's not very nice if it looks like this. Let's delete all this. For example, if you have the VAR exceedances that looks like this. In this case, it might be that you have the correct number, 5, but they are all clustered in time, and in sum, those losses would be detrimental to the bank. So this is another property that your risk model should have, that it produces VAR exceedances that are independent over time. As I mentioned before, the valued risk is not sub-additive in general, and thus not coherent. So it is sub-additive, at least for linear combinations of what we call elliptical distributions, and examples are normal distributions, the normal distribution, the t-distribution, they are elliptical, but for general distributions it's not sub-additive and thus not coherent, meaning what? It will not account for diversification in the way we would hope for. So that's one problem. One extension of valued risk is the so-called expected shortfall, and it was around even before the Arzneimittel, Eber and Heath paper. There are several words for this, several definitions: conditional valued risk, tail VAR, conditional tail VAR. I guess the name that has stuck the most is expected shortfall. And those disadvantages of valued risk, missing sub-additivity, no estimation of tail risk beyond valued risk, these disadvantages have led researchers to study different risk measures, and they realized that expected shortfall, which we will define on this slide and the next one, expected shortfall has some properties that make it a little bit more appealing than valued risk, but it also has some difficulties. Okay. So how is it defined? We again start with the loss distribution L. We assume that it has finite expectation. So the expected value is smaller than infinity. It's finite. We have a distribution function fl, and the expected shortfall at confidence level alpha is then defined as 1 over 1 minus alpha times an integral of the quantile function. Qu is the quantile function. And what is this? Well, I give you a little bit to think about when I give you an idea how to interpret expected shortfall. Remember that for a continuous distribution, how would you calculate an expected value? Remember that for example, a discrete function, the expected value is xi times the probability of xi, and you would sum this all up, and then, well, yeah, that's the expected value. What happens for a continuous distribution? Well, the sum becomes an integral, and you might remember that it's x times the density function of x dx. And actually the same happens here. You can see that this is some sort of a weighted integral over some function values, q. You know that the quantiles, they are all here. And as you can see, we are going from alpha to 1. So let's solve this. It's actually the expected value of those quantiles that lie beyond valued risk. So in other words, it's sort of an averaged valued risk. This is a different version of the definition. But actually, if the loss distribution is integrable, and if it has a continuous distribution fl, then expected shortfall is simply given by the expected value of the loss distribution under the condition that the losses are larger than the valued risk. So it's the conditional expected loss given that the losses exceed var. If we have a loss distribution and not a P&L, this would mean that this is the loss distribution, this is valued risk, and then if we take the mean, the conditional mean of those losses that lie beyond var, we get the expected shortfall. So that's very simply the definition of expected shortfall if L is integrable and if it's continuous. And that's clear. Okay, so this is the expected shortfall. Acerbi and Tasche in 2002 in a JBF paper, they showed that expected shortfall is coherent. So it doesn't depend on the type of distribution, it is always coherent. So this is one basic advantage of expected shortfall over valued risk. The problem now with expected shortfall, and you can see this exactly here, let's assume we have 100 days, we have our loss distribution, and we have the valued risk here, 1%, which would mean that actually make it a little bit, can I make this a little bit smaller? I hope so. We have one observation here. Oh, sorry. I'm doing all of these now. I have one observation here and 100 here. And from these 99 actually, and from these 99 observations here, I can calculate value at risk, or actually I can use all 100 to calculate value at risk, but the calculation, the estimation of expected shortfall is based on 1 or 2 observations. So this is a huge problem because you are looking at the conditional expectation. Your databases is much smaller than for the estimation of value at risk. So even though you have coherence, which is a nice theoretical advantage of the expected shortfall over value at risk, you still have the problem that it is much more difficult to estimate. Okay. Now, this brings us to backtesting. I already told you that you need to check the validity of your risk model in order to account for model risk. And if model risk proves to be too high, then you need to change your risk model. So how do you check for the validity of your risk model? You do backtesting. So we now have 2 frequently used risk measures, and we can ask ourselves, how can a bank check the validity of those risk forecasts? This is the process of backtesting. It's basically quality assessment of risk model using historical data. And in the case of VaR backtesting, you will compare the estimated value at risk with actual losses, with realized losses, just like Deutsche Bank did in the risk report. Now for backtesting, there are a couple of standard tests. For example, it all started with I would say the Kupitz test by Paul Kupitz, who's I think an economist with the Federal Reserve System. And the Kupitz test is simply a very simple test that checks statistically for the correct number of VaR exceedances. The Christopherson-Pelletier test builds on the Kupitz test, and the basic idea is that you have an indicator variable of VaR violations, and you would say, well, let's say we have our losses here, and we have our VaR estimates. Let's use blue line. Say here, okay. And this would then mean that we will transform this information into a sequence of violations. And so on. I would have to go on, and so on, and so on. Let's continue this on this here, and you get the idea, and then it continues until here. Okay, so this would be the indicator variable of VaR violations. 0 would be no violation, 1 is a violation, and this sequence should be binomially distributed with the probability 1 minus alpha for having a 1. And then the Christopherson-Pelletier test, as you can see, we have clusters here, 1, 1, 1, 1, and here. So there shouldn't be too many too extreme clusters, and that's the extension of the Christopherson-Pelletier test, actually. You can check for the right number of VaR violations using the Kupitz test. I should write down the name, which is maybe a little bit Paul Kupitz. And the Christopherson-Pelletier test now includes and extends the Kupitz test by also looking at the number and extent of clusters over time. And we will learn how this test works later using a real data example, but you can already see what it will test for: the correct number of exceedances and temporal clustering. Okay, so now let's move to 3 standard procedures for calculating value at risk, which is, first of all, the variance covariance procedure, Monte Carlo simulation, and historical simulation. So we'll start with variance covariance method. We assume, well, actually not the end of this lecture, in the middle. We have our risk factors, which can be conditional or unconditional, and the variance covariance method is synonymous for the assumption of a normal distribution. So we are actually not, well, we are using the variance covariance matrix, but the basic assumption in the variance covariance matrix is actually the assumption of a normal distribution for the risk factors. So we have xt plus 1 distributed according to a multivariate normal distribution with expectation vector mu and variance covariance matrix sigma, and we assume that we are either given the normal distribution, that it's an assumption, or if it's the result of a linearization, but we assume that the risk factors are normally distributed. Now, if it's linearized, we have the following structure. For the risk factors, we know Ct is a constant, Bt is a vector that is constant, and we've already seen a couple of lectures ago for the equity portfolio example, then the linearized losses are actually given by this vector x, Ct, Bt, and this linear structure using the variance covariance matrix. And what we get is the linearized losses, if we assume a normal distribution for the risk factors and a linear structure for the risk mapping, then we know that the losses are also normally distributed. Which simply, in this case, then means if we assume a normal distribution for the risk factors, or let's normal distribution for risk factors. Second assumption is linearized risk mapping leads to normal distributed losses, L, and this means that var is simply given by, I don't have any formula here, so I have to write it this, mu plus sigma times z quantile. And we are actually done. Why? Because for normally distributed losses, we've seen that there is an analytical formula for the valued risk, but also for expected shortfall. It looks a little bit different, but we're actually done. So we are assuming a normal distribution for the risk factors, a linear risk mapping. Then the losses are normally distributed according to this here, and then we are done. We can immediately calculate analytically the valued risk of a single investment of a portfolio. We are done. Okay. Now, the practical implementation now consists of estimating the expected values, the variances, and the covariances of the risk factors. And this is why this method is also called the variance covariance method, because it relies heavily on the variances and covariances. Now, if there are if these moments are simply determined by sample means and sample variances, covariances, we get an unconditional loss distribution and we have an unconditional model. If, for example, you use a gauge model, then this becomes a conditional model, and then we would have the conditional distribution of xt1, and we have time-varying expected values, time-varying variances and volatilities, time-varying covariances, and this gets a little bit more difficult, but it's still stays the same. We can calculate valued risk analytically. This is the foremost, and I would say the only advantage of the variance covariance method. It allows for an analytical computation of valued risk and expected shortfall. However, we need an assumption of normally distributed risk factors. We need a linearization of the risk mapping, and it can also be extended to other distribution functions, but you need to have distributions that are invariant under linear functions. So again, the assumptions here, these two, they are pretty heavy. This makes the model quite, its use quite limited. Actually, it is used a lot in practice and in the industry, and people need to realize, and they did after the great financial crisis, I hope they still remember that, that linearization and the assumption of normally distributed risk factors are quite restrictive assumptions on your loss distributions. And you shouldn't be surprised that actually the normal distribution has a property which we call, let's put it different. This one is a normal distribution. The problem is historical data looks like this. It's what we call leptokurtosis, meaning that actually extreme observations in reality have a higher probability than they would under the assumption of a normal distribution. And this means that if you use a normal distribution, then those extreme losses will have a smaller probability than under the normal distribution. A higher distribution in reality than they would have under the assumption of a normal distribution. And this is quite problematic in practice, because it means that you will, when you use a normal distribution, a model that uses a normal distribution, that you will systematically underestimate those extreme losses. And during the financial crisis, well, we saw those extreme losses and the models were not correct. So quite problematic. The second standard procedure is historical simulation. So instead of estimating the distribution under the assumption of a specific distribution, we can simply use historical data and use the empirical distribution function. So we begin by constructing a data set of simulated historical losses. Those simulated losses show which loss would occur if the changes in risk factors from historical data were to occur on day S. You insert your historical data for your risk factors into your loss operator. You would get historical losses or simulated historical losses, depends. And then you simply take the empirical distribution function, the EDF of those simulated historical losses. And this is a consistent estimator for the true distribution in the population. So it's very easy to implement. It reduces the dimension to 1, but you need large historical data sets, and it's completely an unconditional model. You would have to use maybe like rolling estimation windows to make this a quasi-conditional model, but otherwise it's exclusively unconditional. You cannot use time-varying moments, for example. So this is historical simulation, and in other words, what you're doing is you're using the histogram. Well, using the histogram, this is a little bit small, using the histogram to approximate the true distribution. And the histogram is then your estimator. Okay. Last but not least, we have Monte Carlo simulation. So this is the third standard procedure. Monte Carlo simulation is, of course, much more general. Monte Carlo simulation is not specific to valued risk estimation, but it is actually a general procedure in statistics. Every time you have a distribution and you want to generate random observations under that distribution, you do Monte Carlo simulation. Why is it called Monte Carlo simulation? Well, it's similar to what you would do in a casino. You know that for a dice and for a roulette table or any other gambling game, you should know the true distribution if it's a fair game. And every time it's played, you have a random observation under that distribution. So if you throw a dice, you would say, well, okay, 2, 3, 5, 6, 1, 2, 5, 6, 6, 5, 2, 1, and you would generate random numbers from, in this case, a uniform distribution. And that's what Monte Carlo simulation does. It comes up with techniques, with mathematical tools, to simulate observations from a given distribution. And what you then would do is, you would assume certain distributions for your risk factors. You would then simulate from these distributions, from these assumed distributions for your risk factors, insert them into the loss operator, and then generate m independent observations from the risk factors and thus from the loss distribution. And then you take the empirical distribution function and model those simulated losses according to the histogram. So then it's the same as an historical simulation, but the difference is you're not using historical risk factor changes, but you're using simulated risk factor changes under a given distribution. Now, what is usually shown and what is usually done in German textbooks on risk management is that these textbooks will say, well, and then you can make the assumption of a normal distribution for your risk factor, which doesn't make sense. Because if you only take a normal distribution for a risk factor and you only have one risk factor, then it's again the variance covariance method. Monte Carlo simulation only becomes interesting if you have a risk mapping that is nonlinear, if you have risk factor changes that are not from the same family of distributions. So for example, you would say I have a normal distribution plus a t-distribution plus a normal squared minus chi squared, and all of this divided by a gamma distribution. In this case, you would see that yes, variance covariance method can no longer be applied, but you can simulate from the first normal distribution, you can simulate one observation from the t, from the second normal, from the chi-squared, from the gamma distribution, and you add them all. So this would simply be x plus y plus z minus a divided by, let's call it b, and this one was squared and this one was squared. So we have 1, 2, 3, 4, 5 simulated observations from these 5 distributions. We add those according to this formula, and then we would have our first observation, which would then be x, 1. So this would be the first observation here. And now you see that the Monte Carlo simulation only makes sense if you have a more complicated distribution that you are assuming, and for example, if it's a nonlinear risk mapping. But otherwise, it's the same as historical simulation, and then you can do Monte Carlo simulation. The advantage is that you can basically use any distributional assumption for your risk factors. You need to simulate a large number m in order for those observations to stabilize and to converge to the true distribution. Problem is you need a computer, and the computational effort can be very high, especially for a complex portfolio. So computation time is a factor here, and you need to keep this in mind. And of course, you need to make a good assumption. The Monte Carlo simulation is only as good as the assumptions you've done on the distribution of your risk factors. If you simply make it like I did, well, this looks fancy. This doesn't need to have anything to do with reality. Then your risk model will be woefully off. So that's Monte Carlo simulation. Okay, so this was the part on risk measurement. I will stop here for a moment and get something to drink, because otherwise my voice will fail me in a minute. So let's stop here. I'll stop the recording for a moment and we'll continue in, let's say, 1 or 2 minutes.